They told investors this was the safer side of finance, a cleaner source of income, a more stable machine than the chaos of public markets. Private credit. It sounded disciplined, exclusive, controlled. But that was the cover story. The real story is much darker. Wall Street found a way to move risk out of public view, hide the price discovery, slow down the panic, and then sell that silence as if silence meant safety. And now the illusion is starting to crack. Because the real test of a market is not how calm it looks when money is flowing in. It is what happens when people want their money back. And in private credit, that is where the lie begins. Private credit sounds boring on purpose. That is part of its power. It does not sound like a bubble. It does not sound like a trap. It sounds like smart money making private loans to companies outside the public spotlight. Stable income, professional underwriting, serious capital, serious people. But strip away the polished language, and the machine underneath is brutally simple. Investors hand over cash because they want yield. Funds collect that cash and lend into riskier parts of the economy where traditional banks have pulled back. Those loans do not trade on open exchanges like public bonds. The prices are harder to verify. The assets are harder to sell. The risks are harder to see. And that is exactly why the product can look smoother than it really is. In public markets, pain is visible. You see prices drop. Screens flash red. Panic becomes obvious. But in private credit, pain can stay hidden much longer. The loans are private. The marks are slower. The market is opaque. So the absence of visible panic gets mistaken for the absence of danger. That is the trick. If something is hard to price, hard to trade, and hard to exit, it can look calm even when stress is building underneath it. And when investors see that calm, they do what investors always do. They trust it. They size up. They tell themselves this is safer than the wild mess outside. But hidden volatility is still volatility. Hidden fragility is still fragility. And delayed pain is still pain. This is where the system gets dangerous. Because private credit is not just a product. It is an incentive machine. Investors want income. Wealth managers want something attractive to distribute. Fund managers want fees. Companies want financing. And everyone gets paid while the structure keeps expanding. The investor hears yield. The manager hears assets under management. The distributor hears demand. The borrower hears capital available. Everyone has a reason to keep the story alive. And when everyone in finance has an incentive to believe a story, that is usually the moment you should get nervous. Because what is being sold here is not just return. It is confidence. Confidence that the loans are worth what the marks imply. Confidence that defaults will stay manageable. Confidence that liquidity will be there when needed. Confidence that private means protected, not trapped. But the structure only feels elegant as long as not too many people test it at once. That is the hidden weakness. In a public market, the ugliness is immediate. In a private market, the ugliness can be delayed. And delay makes weak structures look stronger than they are. It buys time. Time to manage the narrative. Time to avoid ugly repricing. Time to pretend illiquidity is sophistication. Time to keep collecting fees. Think about the psychology of that. You were told this market is more stable because it does not swing around like public assets. But what if it swings less simply because it is harder to see? What if the calm is not proof of safety? What if the calm is just the result of opacity? That changes everything. Because the product stops looking like a shield from volatility and starts looking like a place where volatility goes to hide. And once you see that, private credit stops feeling exclusive. It starts feeling engineered. This is how financial systems fool people. They do not always lie directly. They reframe the weakness as a feature. Illiquidity becomes patience. Complexity becomes sophistication. Slow pricing becomes stability. Limited transparency becomes exclusivity. And by the time investors realize the difference, the trade is already crowded and the incentives are already locked in. That is why the exit matters more than the pitch. In finance, getting in is easy. You get the deck, the sales language, the yield target, the reassuring story. But the truth lives at the exit door. It lives in the moment stress rises, redemption requests build, and money suddenly wants to leave faster than the structure was built to allow. That is the part regular investors were never meant to focus on. Not the headline yield, not the prestige of the firms, not the promise of private access. The gate, the delay, the mismatch. The uncomfortable possibility that the money is never quite as available as it felt on the way in. Because if the asset is hard to move and the investor wants liquidity, somebody has to absorb that tension. And when enough people ask for cash at the same time, the system has to reveal what it was hiding all along. The stability was conditional. The liquidity was conditional. The confidence was conditional. And conditional safety is not safety. It is borrowed calm. This is why private credit fits perfectly into the modern financial world. We live in a system obsessed with yield, starving for return, and terrified of visible instability. So Wall Street built a market that appears to solve all three problems at once. It offers income. It keeps the mess out of sight. And it gives the impression of control. But when a market's biggest strength is that you cannot clearly see the stress inside it, that strength can turn into a weakness very fast. Because once belief starts to slip, opacity stops protecting the structure. It starts poisoning trust. The same hidden design that made the market feel calm becomes the reason people rush to reassess it. And hidden systems break differently. Quietly at first. Technically at first. Then suddenly in public. That is what makes private credit such a powerful illusion. It does not need to look exciting. It only needs to look controlled. And for years, that was enough. As long as money kept coming in, as long as defaults stayed contained, as long as nobody pushed too hard on the exit door, the machine could keep presenting itself as smarter than the public market. But every hidden system eventually meets the same question. What happens when reality arrives faster than the structure can absorb it? What happens when investors want out? What happens when the assets cannot become cash without pain? What happens when the beautiful story collides with liquidity? That is when you find out what was real. And that is the real reason this matters. Not because every private credit fund is about to explode tomorrow. Not because this is automatically the next 2008. But because this is how systemic trouble begins. Not with one dramatic headline, with a pattern. A shift in confidence. A few stressed exits. A few uncomfortable questions. A few moments when investors realize the structure is not as simple as they were told. And once that realization spreads, the entire psychology flips. The private label no longer feels protective. It feels restrictive. The smoothness no longer feels reassuring. It feels suspicious. The yield no longer feels generous. It feels like compensation for a risk people did not fully understand. And that is when the machine gets exposed. Wall Street did not just build a market for private loans. It built a market that could look safer than it really was, because the dangers stayed behind the curtain. A market where opacity could be mistaken for strength. A market where illiquidity could be packaged as discipline. A market where investors could believe they owned calm, when what they really owned was delayed stress. And that is the hidden truth. Private credit was not just sold as income. It was sold as control. But the deeper reality may be much uglier. Because in the end, this was never really about yield. It was about whether the system could keep the illusion alive long enough for everyone collecting fees to get paid before the pressure became visible. And if that illusion is breaking now, then private credit is not the safe corner of finance. It is the next hidden trap.